Okay, let's kick this off, Sam. My name is Jeff Baker. I'm President CEO of Sortis Holdings and a fund manager in the Sortis Income Fund. I'm here with Sam Ross, my partner, who's also a manager of the Sortis Income Fund. And we're going to give you an overview of the Sortis Income Fund, as well as just some thoughts about what's going on in our world and what's ahead. A couple of housekeeping things. We may want to have you put your view on gallery view. My hope is that you can see our screen, our presentation deck, and then you can see myself, Jeff Baker, and you should see Sam, and we'll, between the two of us, we'll cover the items we have on our deck today. We would ask that you put your questions in the chat feature. We'll do our best. We've got an hour. I don't think we're going to need that entire amount of time, but we'll do our best at the end to be able to answer all those questions. And we'll just go through that towards the end of the webinar and take care of those. So first off, let's see here. Disclaimers. This is our page of disclaimers about forward-looking statements. In reviewing all of our documents, our risk disclosure prior to investment. This is standard stuff that you see on virtually all of the decks here. Okay, so the Sortis Income Fund, we call it the SIP, and so you may hear me refer to it as that. The SIP, we're an unlevered evergreen investment fund. We make real estate loans, generally in the West. And so we're heavily concentrated in the states of Oregon, Washington, and Colorado. We would lend in other Western states, but we've found in terms of the terms that we can get and knowing the markets really well, we like Oregon, Washington, and Colorado. Demographics around Portland, Seattle, and Denver are very similar, and as they relate to real estate values, we like what we see. The fund does commercial and residential lending. We primarily these days have a commercial focus, and in all honesty, that's evolved a little over time. We started doing a lot of residential loans, fix and flips in our early days over 4 years ago. But as the fund grew in size, we finally could embrace more of the commercial lending that we do today that's in line with our background, whether it be in banking or and so we really focus in on commercial, and we think that our expertise is valuable to this fund, and we're able to deliver an above market yield, really focus on kind of the metrics of commercial lending.
Hey, Jeff, I think you need to move a little closer to the microphone. Sounds like some people are having trouble hearing.
Okay, let me get that, make a little adjustment here and see if that helps. I'm going to make sure that my volume is all of the way up. Sam, how does that sound?
I can hear you. That's much better for me.
Okay, okay. Well, let's see. I was just mentioning that we're a commercial and residential lender, but we really like commercial, both for the loan real estate value as well as the metrics we can achieve for our investors. The SIF has a $25,000 minimum for our accredited investors. We've kept that intentionally low. We've started from scratch, and we've built that up to somewhere between 75 and 80 million today. When we first started this fund, we were around 4 million or so in our personal and family and friend investment, and that's been maintained. Used to be a much larger percentage of the portfolio, but it's still there. But we've really appreciated that we've accumulated somewhere between 450 and 475 investors, and they really have been what's allowed us to grow this fund. And so we very intentionally left our 25,000 minimum. We think we have a pretty generous liquidity policy. After 6 months with us, we allow you to exit. This requires just filling out a redemption form and letting us know. Our PPM really allows us to handle redemptions at quarter end, but our practice for the last 4 years has been to take care of those right away within a day or two and wire funds as people need those. We really haven't had that much experience with redemptions. We've, I think, provided a pretty nice return to our investor base, and so our fund has grown, and we have had very few people leave us over our life. Our target investment return is 10%. In fact, life to date, we're in excess of that. We've bounced around that a little bit. We were 9.5% in Q4. And we'll see how Q1 here plays out. We're optimistic we may get close to this 10% number, but we'll see. We have a few loans to close to ensure that we're able to achieve that. We provide cash flow quarterly, and so all of our investor base can elect to reinvest their earnings, or they can take a distribution of those earnings. And so a lot of our retirement investors tend to invest with us, and they roll over their earnings, while a lot of our taxable investors, about 80% of our investor base, may consider a distribution of the earnings as they look for cash flow. We're available on Schwab, TD Ameritrade, and most or quite a few self-directed IRA platforms. Getting ourselves pulled up on an IRA platform is pretty straightforward. And so we can do that for a lot of our investors. And so we're readily available in a lot of different ways. Life to date, we've had no losses on any of our loans, which is something we're proud of. We think we do a good job in terms of how we maintain this portfolio. We were pleased to see in Q4, as we put out a loan tape to our investor base, our average LTV dropped from 65% by a couple of basis points down into the lower 60s as we continue to see good loan opportunity. A lot of people ask us about who we are and why we exist. And I'll get a little bit to it in my bio. Some of us come out of banking and we understand exactly what banks do and exactly what banks don't do. And so banks are really, they respond to the environment, to regulators. And so they've post last recession, 2008, starting of that last recession, banks really pulled back in terms of construction and a lot of financing on commercial real estate projects. And so we exist to provide and step into that market, as private financiers. Some people call us hard money lenders. We step in and we make short-term, quick loans. So banks like really long-term amortizing loans. We make a short-term interest-only loan. Oftentimes our borrowers only need financing for 6 to 8 months. And so our standard loan product is a 12-month interest-only loan. And that just fits well with what folks need. But most importantly, they just need us to show up and deliver. And, a bank can take 3 months to tell someone no. We're going to show up pretty quickly. And Sam will talk a little bit about that in terms of our lending practices here on the next slide. And we continue to see some of our competitors having challenges, those that sell into the secondary market, those that rely on leverage. We're unlevered. We just lend our investor capital, and so it gives us a lot of discretion, and we know exactly what funding we have, and we can control what we put out and what's available as we manage our liquidity. As I mentioned, our borrowers know that we can close quickly, and we'll tell someone no pretty fast. We'll do a quick underwrite, and we can tell pretty quickly whether it's something that has legs in terms of our fund. And as mentioned, we allow a pretty quick payoff inside of 12 months, and sometimes borrowers just need money for even 3 or 4 months to accomplish a purchase, to do some sort of fix, or looking for their next refinance at cheaper financing. We'd mentioned COVID in a sad sort of way. While we wouldn't wish this environment for anybody, it's been great for the Sortis Income Fund. We continue to see people pull back on financing, which gives us more opportunities. We get to choose which loans we put in our portfolio. We've had some better underlying metrics that we like in terms of loan to value. And we've been able to implement some terms in terms of additional fee structure that flows into the fund. Investment strategy, Sam, why don't you take this one and tell them a little bit about what we're looking for as we lend.
Yeah, thanks, Jeff, and hi, everybody. As Jeff said, I'm Sam Ross. I'm one of the fund managers alongside Jeff for the Sortis Income Fund, and I'm a vice president at Sortis Holdings as well. So I spend my days focused on the income fund, generating new business, sourcing, structuring, and closing, and then managing the loan portfolio. And so with respect to the income fund strategy, it's all about the collateral. It's all about the real estate. And for us, I think that's an important point compared to other traditional lenders, is that we are real estate investors first and foremost. And so we have the ability, based on our collective experiences, to really understand the collateral. Good real estate is good real estate, and that's what we want as collateral for these loans. And so it's about understanding the collateral. And then more importantly, with a lot of our loans, is understanding the business plan. So we're typically bridging people from point A, which is some problem that they need to solve, to point B, where they have executed that business plan, solve that problem, and they can move on to either sell their asset or get more permanent long-term financing. So good real estate with a bad business plan doesn't work, and a good business plan with bad real estate also doesn't work. So we really dig in to understand what's the collateral, what's the plan, and does it make sense from a real estate perspective. Once we understand that, we're able to really structure a debt solution in the form of a first mortgage loan that accomplishes those goals for the borrower and pays the Sortis Income Fund a rate of return commensurate with the risk we're taking. To us, problems that borrowers are experiencing, whether it's a quick purchase, their other bank, declined to make a loan or bailed on them, those are just opportunities for us, and that all comes from our experience as real estate people. So we think that gives us an edge, and that allows us to understand these deals at the nuts and bolts level and really be able to understand and create solutions that other groups won't necessarily uncover if they don't have that experience or they don't have that mindset of the real estate investor. In addition, a core fundamental piece of why the income fund is successful, and we believe will continue to be successful, is, as Jeff mentioned in the opening slide, Sortis Income Fund has no leverage, zero. So it's all investor equity, and that does a couple of things that give us an advantage in our business. And the most important, and one of the big takeaways from 2020 has been, is borrowers want certainty of execution. When borrowers have good assets that will survive COVID and be long-term viable assets, but with short-term liquidity problems, that causes a lot of distress and anxiousness on the part of the borrowers. And on top of that, during a panic, or during what happened last year with COVID and capital markets becoming volatile or closed to a lot of borrowers, these borrowers want to know that they're not going to lose their assets, or their whole business plan won't be turned upside down. And by being completely unlevered, and being able to have a stable, strong balance sheet for the Sortis Income Fund, we can be kind of that, stable ship in the sea, so to speak. And even though we will almost certainly be a more expensive financing product for these borrowers, they want to be able to close a purchase, buy out a partner, solve litigation, keep a project moving. And so being able to show up on time with the right amount of money and perform our obligations in a timely manner is really important, for the borrowers, and that gives us the ability to, be a trusted financing counterparty especially during volatile markets like we're seeing right now. As Jeff mentioned, all of us come from banking, real estate, and we all have distressed backgrounds. I started my career in 2010 acquiring and restructuring distressed debt. So I always like to say that I learned how deals could go wrong before I learned how deals could go right. And you get to see a lot by really digging in, rolling up your sleeves and trying to figure out, solutions for, sometimes very complicated situations. And so that helps us create opportunities where others may not see it, but also it gives us a big advantage in how we manage and service our portfolio. When a borrower has trouble during the life of our loan, we're able to step in, have a phone conversation with them, understand what the current situation is, and help them then through a solution that both preserves our principal return, preserves our returns, and helps the borrower, keep their business plan moving. So it gives us an advantage both in finding and creating new opportunities, but also that translates into a more active and more successful servicing program. As we said, COVID-19, while it is unfortunate what has happened in the world, broadly speaking, it has been a boon for the fund, given our conservative structure and our focus on high quality collateral. And during the environment, we've actually seen, I think we did 27 or 28 loans for the calendar year 2020. And compared to 2019, our pricing on those loans actually increased, while our risk profiles decreased in terms of both decreasing loan to value and being able to cherry pick better collateral, being able to cherry pick better business plans to loan money into. And so it's created a positive effect on the fund. So you're probably saying these are all complicated deals. How is distress going to keep moving forward? How are you going to find new deals? And so we do that in a couple of ways. The first is just our own personal networks that we've developed over the years. And then and that comes, with building our reputation as creative problem-solving lenders. And so that allows us to get a lot of the first phone calls when a borrower is having a particular issue. And even if we don't end up doing a loan to that borrower, we at least get the phone call, we get to learn about it, and we can at least get them a quick yes or no. But so that track record of success and in resolving problems and using the loan business to do so and generate attractive returns for the investors at the same time, results in a lot of repeat borrowers and has generally given us a good reputation that continues to build in the marketplace as a go-to financing counterparty. A second one is banks. Jeff, his whole career, Jeff has been in the banking industry and his networks are deep there. So loans that may not fit in the box of a bank, we get, and I guess this goes for mortgage companies too. A lot of those groups see deal flow that does not fit within their own programs for one reason or the other. So we get a lot of referrals, from other capital market participants. A lot of our loans are made to help resolve litigation or bankruptcies, which has allowed us to build a network of both bankruptcy, receivership, and litigation attorneys. And so if we're working on a deal right now that has been a messy bankruptcy for a year, and our loan will solve and pay for all of the required payments, and the asset will come out of the bankruptcy free and clear, and we'll have a first position mortgage against that. And so also being able to solve complicated litigation and bankruptcy issues gives us an advantage in the attorney circle. And then one final group that we're starting to see more deal flow percolate to the surface is other leveraged lenders in the marketplace. So remember, Sortis Income Fund has no leverage, but there's a whole universe of private leverage lenders that don't do exactly what we do, but do something similar, but they have their own financing. And so what we saw in 2020 and what's continuing is those leveraged lenders, their financing sources are drying up. And so that results in not being able to meet their obligations on construction loans and not being able to originate the same volume of new deals. And it does not give them the flexibility to restructure loans because they have a big financing lender behind them with a whole second set of covenants. So it puts them in, it puts a certain level of handcuffs on those groups, which allows us to both get referrals from them. And what we're starting to see is potential note purchases at modest discounts. So the deal flow comes from a lot of ways. And actually one that I would add that is not on here is, we'll talk about one of the loans later in the webinar. But as many of you may know, Sortis runs real estate equity businesses in addition to the Sortis Income Fund. And so what that does is that opens up a whole new funnel of deal flow for us. And so what often happens is a deal will come in through one funnel, and after we've underwritten it and learned about it, oftentimes it ends up being a different deal. And so equity deals, a deal may come in the door as an equity deal that we think is actually more of a loan deal. And so by having both a debt business and an equity business, we have a broader funnel for which deals can come through into our pipeline, which we think is a real advantage compared to a group that only does one particular business.
Okay. Next couple of slides, I wanted to talk a little just about risk mitigation. We're going to stress that we're unlevered. You'll hear that a variety of times from us. This particular slide, we just like to show, given that we all came through this last recession, this is an example of a stress test. And while we have modest exposure on the residential side, we'd like to remind folks that in the last recession, which was pretty horrific in its own right, we did see somewhere around a 50% drop in residential real estate values per Case Shiller. But it turns out that happened over a 4 or 5 year period. It was a little bit of a long, slow bleed. And so we like to highlight, our general loan, we come in at 65, 70% loan to value. So we got a 30, 35% hedge. And if you look in that last recession, in any individual 1 year period, there was no more than a 15% decrease in real estate values. And so if we're lending on a 12-month interest-only loan, even allowing a little time for foreclosure, and we're lending at 30, 35% hedge, a 60, 65, 70% loan to value, this slide is attempting to show that in a 20% decline, which was worse in a 12-month period than any 12 months in the last recession, our real estate collateral still exceeds our loan balance, and we still are protected, if you will. And so this is just a reminder that if we're doing short-term loans and we're disciplined about our loan to value, history would show that we have a great shot at really protecting principal, which is, by the way, the #1 goal in the Sortis Income Fund. We take a lot of pride in delivering above market yield, but protecting principal is really what we're designed to do. A couple of other thoughts. We've talked about leverage a bit. We like to mention default risk. We have tremendous experience in working through troubled assets. We know all of the strategies. We've got great connections with attorneys in that area, with receiverships. We're managing through a couple receiverships now, bypassing foreclosures. We've got deep resources as it relates to construction, development, taking an asset and working through, taking it to its next stage versus a fire sale. So we have a lot of ability to deal with anything that should come our way. Unfortunately, that's been relatively modest, but we have those skill sets should we need them. Liquidity risk, once again, we're a short-term lender. Our average loan life is somewhere between 6 to 8 months. That's on our standard product, which is a 12-month loan. So we frequently have prepays. Borrowers should be trying to take us out and finding cheaper financing. And we love that because we get that money back. We get to redeploy it and earn some more points, which all flow into the fund to its benefit. So liquidity has been something we've always had. We've had good growth. That's money coming in. We've had very low redemption rates. We've never gated redemptions. Like I say, we're a phone call away and a form to a next day wire. That's our practice. It's not stated in our policy, and that could change, but that's been our practice, and we've been able to do that. And then once again, interest rate risk. If we just keep our lending short term and we see some variations in the market, then we can react, and our new loans will price with new interest rates. Although I would like to say we are not tied to prime, we're not tied to LIBOR, we are not tied to any sort of bank financing rate. Our interest rate is really a function of supply and demand, and so it's our competition in terms of where they're putting rates out there at. So you may have seen on the residential side especially, we have a lot of people trying to get in that game, a lot of money circulating, it's driving rates down. We're licensed to lend in California. We don't have one loan in California today. People are willing to put hard money out at 8% and 1 point, and we just don't think you get paid for the risk at that. We're going to stick with trying to get 2 or 3 points and a 12% interest rate, and so that's a risk that we would like to avoid in terms of having the ability to do more commercial lending. A little bit about us. I'm a product of Oregon. I started my life as a CPA, and so for about 10 years, I ran around and audited mostly banks in the Northwest. I joined a bank in 2005 as its CFO, and that was after 10 years of busy seasons. It was a nice break to get into private. 2005 was amazing. 2007, 2008, life got really tough as the recession hit. And so we got to work through a lot of challenges in the next few years, going through that recession. Somewhere in there, I became the CEO of the bank, and in all honesty, it wasn't necessarily that I was a young, capable exec. It was no one in their right mind wanted to step into those shoes after the FDIC made us let our prior CEO go. But I was in the mix, and so I fell into that role, and I'm proud to say I made a few early good decisions, and one of those was to network and bring in a couple of the guys I'll talk about next on the next slide to help me in terms of working through tough assets at our bank. And we were able to get that bank on good footing, return it to good health, and then, like many little banks, a bigger bank came along and made an amazing offer for our shareholders, and we decided we needed to take that. But we weren't done. We wanted to continue to work together. And so the bank holding company, which has been around for 20 or so years, became Sortis Holdings, and we launched our private financing funds. But this is on the heels of having been a bank and been a commercial lender since 1995 in terms of that form. And so that's my background. And so I get to do a lot of work on the administration side of the fund, working on financials, reporting, compliance. I do a fair amount of fundraising, if you will. If you want to talk about the Sortis Income Fund, you'll frequently find yourself talking to me, like it or not. And I've got lots of good things to say about what we do in our funds. But Sam, why don't you tell them a little bit about yourself, and then we'll chat about a couple of other people on our team as well.
Yeah, absolutely. So again, my name is Sam Ross. I'm a vice president at Sortis Holdings and a fund manager at the Sortis Income Fund. So my day job here is sourcing, structuring, executing, and then managing the loan portfolio alongside Jeff and other members of our team. And so my career started in 2010. I moved to I had a few internships in Chicago, and then I moved there after graduating college full time at a small opportunistic real estate fund that was acquiring and restructuring distressed debt in the wake of the 2008-2009 crisis. So I was in charge of a couple portfolios of distressed mortgages that we worked through, restructured, and ultimately generated substantial returns for the investors. Once that business faded as the world recovered in the early 2010 to 2013, range, I moved into originating commercial bridge loans, which is what Sortis Income Fund does. So I originated a few portfolios of loans during my time, and then worked on structuring opportunistic real estate ventures. And I've always been in small shops where you're forced to wear a lot of hats. So I've got direct experience all the way from property management, fielding phone calls at 2 a.m, all the way up to closing, large, complicated commercial transactions. So I have a fairly well-rounded background, all focused on real estate. I'm originally from New York before I went to Chicago, and I've been with Sortis now for about 2 years, and I plan to be here for a long time as well. And it's been great working alongside our small team, and especially with Jeff. The growth of this fund has been phenomenal, and we've been able to generate consistent returns in connection with the substantial growth, and the trust that you, the investor base, and the confidence in us has been terrific, and we're excited about this portfolio and this business.
Yeah, excellent. Let's see here. Okay, so I wanted to talk a little bit about a couple of our team members. While they're not fund managers of the Sortis Income Fund, I frequently get questions about, hey, are you guys spread too thin? You've got a lot of stuff you're working on. And so I did want to share, we have a deep bench here at Sortis, and specifically people that spend time and energy on the Sortis Income Fund. So Paul Brennecke is executive chairman of our board, really in charge of kind of the strategic direction, a lot of what we do in terms of some of our activities at the holding company level. Paul's a long-term private hard money lender in his own right, 30 plus years that I think he's been doing that, and he is well connected to a lot of deal flow sources, and so he's frequently feeding us deal flow. On the loan side, he's pretty sharp as it comes to underwriting, of course, and so he can ferret out really quickly, whether we've got workable deals or not. Paul's a large-scale developer. Over his life, he's built every property type, and whether it be thousands of residential homes, assisted living, hotels, office space, all across the gamut. And he currently works with an affiliate of Sortis in terms of his active development. So his current project is a $500 million office building in downtown Seattle that is funded or was purchased by a large hedge fund. Paul redeveloped that project. He put Amazon in there, and so he gets to deal with Amazon real estate on a weekly basis. And he is also finalizing the retail build out of that. And I mention that because I think it's really helpful for our investors and people that are exploring who Sortis is to understand the depth of the activity we do. Sam alluded to it. We get deals in that we look at for equity ownership. So we'll put together loan acquisition deals. We've got investors who want that kind of activity. We do active development. Paul runs several teams of people. And so whenever we need to leverage somebody to go do an inspection on a development project of any kind, they've had a lot of expertise. And so we have access to those kinds of resources when it comes to underwriting loans and managing our portfolio, if you will. Paul's also been really active along with Sam in our rescue fund. And so he has a particular skill set in terms of acquisitions throughout his life. And so he understands the bankruptcy process very well. And so he's been instrumental in some bankruptcy acquisition type work that we've done in our rescue fund, which is really a distress fund that we started for COVID. And I'll talk a little bit more about that towards the end. I'll mention a couple of our other activities. But Paul's instrumental in a lot of the work we do in the Sortis Income Fund. Michael Sander, another one of my partners, he has been with us from day one. He and Paul both came to our bank and they helped bail us out, or helped us work our way out of our troubles through that last recession. Michael does a lot of work with me on the capital raising side. He's our guy as it relates to our opportunity zone funds. And so he spends a lot of time with investors and talking through projects, vetting various activities in that area. And then he also feeds us a lot of loan activity through all his broad network that feeds into our Sortis Income Fund. And so just highlighting, we have good people and deep resources related to the Sortis Income Fund. We do a lot of other stuff. You know, we do development, we do real estate acquisition. We run a total of 5 other funds. And so we do have a breadth of activity, but we've got some really experienced people that are feeding in and spending time in the Sortis Income Fund. Okay, wanted to touch just a high level on the kind of the Sortis Income Fund. We've talked about a lot of this, but I just did want to touch on a couple of things as it relates to our real estate investment strategy. We're generally first position on our loans. I mentioned we're trying to make a 12-month loan. You know, we have the capability of going longer. We'll frequently build in extensions for fees if we really like the asset. And so we have the ability to take a loan a little bit longer in some conditions. I mentioned and talked through our management team. We've had a lot of experience, whether it be commercial lending, residential lending, distressed work, real estate acquisition. And so just once again, I highlight that we've done a fair amount of this type of work we're doing in our past. We close our loans in a fairly bank-like process, if you will. We have a loan review process with our group. That we make decisions about which loans we will or won't do. We do background checks on borrowers. We generally require guarantees from folks. We close through your typical title and escrow process with insurance. And generally we have some version of a real estate evaluation in our loan file for most of our activity. So our loan files and our loan closings are very much institutional like, just given that's where we've come from and what we've done historically. Let's see, we've got this is a little dated, our loan to value 65%. I saw something in the chat I'm going to respond to. I'm going to pull up our loan tape. Our LTV is a little bit lower than that on average today. Our weighted average coupon, you know, we say 12%, technically it's 11.94, so we're right there. Average life is around 8 months or so in our portfolio, so very short term in nature. I think I mentioned before, we've never lost any principal on any loan. We have the opportunity to forgive interest or default interest, all of which flow into the fund. But we're really conservative. If we have something going into a troubled spot, we're going to take a hard look. We may stop accruing interest, and if we get something back, it becomes a recovery in the quarter it happens. We don't want to see any write-off of some receivable that we've been accruing. And so we're very conservative around how we treat anything that's got a hiccup, if you will, in terms of interest receivable. Life to date, over a 10% net return to investors. And that's something we're proud of. Although I like to tell you, we are focused on principal protection. That is our goal, but we really do take a lot of pride in trying to get to that 10% mark. That's just something that we're going to try and do as best we can, even though it may be challenging at times. Okay, so we're going to talk about a couple of deals. Sam will mention these. We just want to give you a flavor for some of the things we're seeing and some of the types of things that we do. I think it sets us a little bit apart from some other types of funds, but we're extremely excited about these types of projects, these types of loans, and what we're able to get. So Sam, why don't you walk them through a couple of these deals?
Yeah, thanks, Jeff. So we'll just take you quickly through two deals that we did in 2020, as we think they highlight a lot of what our capabilities are. And by talking about a deal, it will put everything that we've been talking about kind of into practice. So the first loan, we made a loan in September on an apartment building on the waterfront in Kirkland, Washington. So going back to good collateral, they don't make waterfront property in Kirkland anymore. So it's a A+ irreplaceable piece of real estate. And the reason we got involved in this deal is the borrower of the project was not a sophisticated real estate owner. He had some family money that he had invested and acquired the project, but he was not a career real estate person, and he was not a sophisticated operator. And it led to a lot of vacancy and a lot of mismanagement at the property level, which resulted in an inability to repay the existing debt on the property. He started to be foreclosed on. We were actually originally contacted through the equity channel to potentially put in a preferred equity position to the deal. And once we looked at it, we realized that wasn't the right risk profile. The right risk profile for this deal was a loan. And so we proposed that idea, and the borrower kind of went away. And then they came back around about a week before their foreclosure date, realizing that they had a good asset that will survive and thrive post-COVID with implied equity, but they had an acute short-term liquidity problem. And so rather than losing all of their equity in their cash investment, they decided to call us back and see if we could make a loan to pay off the existing debt and avoid the foreclosure. So I think we got a phone call on a Thursday night. We worked all the weekend. We ended up closing on the following Tuesday. We loaned $7,125,000, took a first position, and we were able to leverage our network, and we required the borrower to hire a preferred Seattle investment sales broker. And so they immediately listed the property for sale after we closed, ultimately generating a sale that resulted in the borrower, getting most of their equity back. And our loan was out for 120 days. We were about 72% loan to value based on the sale price. And over the course of 120 days, we made a $570,000 profit and a tidy 30% IRR. So that just gives hits a couple of highlights. Came through a different deal channel that we were able to decide it was a loan. Speed, we closed in five days. And we leveraged our network to ensure that we had transparency on the sale process and know that the borrower wasn't simply waiting around for something good to happen. We actively gave them other people within our network to facilitate a resolution. And then the second deal was the first deal we did right after COVID hit. So I think we closed in April 2020. And so this deal, funny enough, was actually a victim of the first financial crisis. And the picture you're seeing on the top left is the condition that the building was left in 2008, 2009, when the original developer went bankrupt. The project ended up in litigation over construction liens for 8, 9 years. They were finally resolved, and one group was able to acquire the property. Our borrower purchased it with seller financing in late 2019. They immediately signed a lease for 20,000 square feet with a global insurance company on a triple net guaranteed lease. He had to deliver the space by September of 2020. He had a construction loan lined up to close in April 2020. And obviously with COVID, that lender pulled the plug. So now the borrower was stuck between a rock and a hard place with the seller financing coming due and no new loan to continue the construction to get his tenant, which has tremendous value into the building. So we were able to step up. We originally did just over a $6.5 million loan to both refinance the existing seller loan and provide additional funds to complete the tenant improvement build out and some core and shell work for the building. Once the tenant moved into the building, and I went out and visited it shortly thereafter. So we saw the tenant, occupying and paying rent. The lease payment actually covered our debt service 1-to-1, despite the tenant being only about 20 to 22% of the overall building. And so the borrower then was working on a refinance, but they needed to complete kind of a smaller annex building adjacent to this one. And so once the lease was in place, we understood that the value was much higher. So we actually agreed to loan another little over $3 million to finish the building. And as it stands today, the building core and shell are done, certificates of occupancy, and the tenants in place. And we think conservatively, the value of the building today is about $25 million. The loan comes due in about 2 weeks. The borrower is at the finish line with their new lender, who will take the project to the next stage. And assuming that payoff comes as scheduled, the Sortis Income Fund will clear over $1.1 million of profit and generate just over a 20% rate of return for a 10-month loan. So this one kind of gets to the points we made about finding great assets that had short-term liquidity problems, being a stable and certain financing counterparty. The borrower was obviously in a tremendous amount of stress. And this also goes to our ability to understand a complicated business plan. This was a partially constructed office building in Colorado and had its own set of challenges. And so we rolled our sleeves up, understood the business plan, we believed in it, and we felt that the reward we were getting far outweighed the actual risk we were taking. And presuming the payoff happens in 2 weeks as scheduled, we think that this proved to be true. So those two deals, I think, just talking about them in practice gives you a flavor of how we take our strategies and what we look for and our core principles of how we operate the fund and translate that into loans out in the real world to be able to generate consistent, stable returns for investors that we have.
Okay, well, so I'm going to try and move quickly. We've got about 10 minutes left, and I want to try and get to these Q&As, but just a couple of things. Effective January 1st of this year, in 2021, we implemented what's called a subsidiary REIT structure. We've been talking about that in our letters to you investors. And this really is not very visible by anyone in the fund, and it doesn't, we did not become a REIT. We are not implementing valuation issues. It's really, we created a wholly owned subsidiary of the income fund to hold the loans so that they were earned inside a certain type of entity. And it gives some tax benefits to our taxable investors. So in 2020, Sortis Income Fund is an LLC. All of our investors are members. The Sortis Income Fund held loans, and we send a K-1 out to our members. We're trying to get those out by early March this year. The sub-REIT fund, Sortis Income Fund, is still an LLC. It is now the parent of a subsidiary, which is a REIT. All of our investors are still members, and they still will receive a K-1 in 2021. The difference now is the REIT is the entity underneath the income fund that holds loans. So the income is earned inside the REIT, and then the REIT will issue a 1099 up to its parent, the Sortis Income Fund, and the Sortis Income Fund will continue to issue K-1s to its members, but the income is recharacterized to have the aspects of REIT income, if you will. And so what that really means for our 80% or so taxable investors is you get access to that QBI deduction. So 20% of your federal income is non-taxable on this income. And then for our larger investors that potentially had a risk of potentially needing to file state of Oregon tax returns, this completely removes that risk, and you will file a state return in your home state only. This is a trend where a lot of funds, as they've achieved a certain size, are starting to migrate in this direction. And I think this is a great tax solution for our taxable investors. Just a quick summary. Once again, I'm not going to go through all of these. I want to touch on one thing that's been a question. So at the very bottom of this, we say available on Schwab, TD Ameritrade, many self-directed IRA platforms, and that is true. We were available on Fidelity until just recently. Fidelity sent us a notice that they elected for business reasons to remove us from their platform. We don't know why. Fidelity won't provide an explanation. We've had our registered investment advisors, the folks that reach out, that work on the Fidelity platform, have spent some time. Nobody can determine why Fidelity came to this decision. We're left to believe potentially, maybe it's that we're small, maybe it doesn't fit in Fidelity's revenue model. But in any case, we're unable to get any information from Fidelity, nor are our investment advisors able to discern what led to that decision. But it is something that I know it's a question in the chat, and it's something that people have asked about. Why are we no longer on Fidelity? And the fundamental answer is we don't know. Fidelity just sent us an email and said we made a business decision to remove you from the platform. That's all we get. With that, I think that covers most things. We do have a couple of other funds. I was going to spend a little time talking about our distress fund. We've had some really cool strategies we've been able to employ, purchasing operating companies out of bankruptcy and immediately applying for PPP funding, and in some cases getting more cash than what we paid for the company to provide a capital pathway for those companies to make it through COVID. And if we see them return to just a fraction of their pre-COVID valuations, that will be very, very meaningful for that fund. So exciting stuff and innovative strategies going on there. With that, I am going to go into the chat here, and we'll do our best to move down through these items. And bear with me as we had some early issues with our mics. Hopefully that got resolved. So we're there. There was a question about this will be available through, I think, our weekend read at a minimum. So this is recorded. We'll make sure that this deck is available to anybody that wants it. One of our good investors asked Sam why he got stuck in a garage. You know, this is part of the motif of our space, a redone warehouse-like district office, which we all enjoy being in. Let's see. There was a question about Fidelity, which we've talked about. We really don't know what the rationale for that was. The REIT we talked about briefly. Hopefully that was fairly straightforward.
So on recourse, Michael has a question. So it just depends. It's a deal by deal. Generally, on smaller loans, it'll be recourse. Even larger loans will be partial recourse in most cases. And even if we write a non-recourse loan, if the dynamics of the loan means that that makes sense, they still have very significant heavy-handed bad boy carve-outs in the event of certain defaults or bad acts on the borrowers.
Yep. Let's see, the question about what percentage of funds are deployed. We try and get all the money we can out to work as best we can. We're unlevered. So what that means is we don't have an operating line. So money comes in, we got to deploy it. And so, we just have to do a good job of managing our liquidity. So the answer is we try and put all money to work as soon as we can, but loans have to meet our demanding criteria. And so there's times when we'll carry a little liquidity as we're waiting for the deals that we like. Does SIF lend on projects where Sortis is also the developer equity? No. If a deal goes bad, when does it hit investors? Well, I think, as I said, we've never had a deal go bad per se in the terms that relates to a hit. So we've never lost any principal. So if a deal goes into a past due category, probably 90 days or more, we may stop accruing interest income in the fund. And so there's the potential that'll have a modest, minute impact on returns. But we've never lost any principal, like I say, on underlying collateral. We'll go get it, sell it, and recoup our principal. I like LTVs in the 60s, me too, but a max LTV per loan criteria, will probably stretch to 75%. We're looking at a large deal that is in our market that will probably be close to 75%, where it actually will qualify for HUD financing. It's a fully built, occupied apartment building that we have a lined up lender to do a takeout. The borrower needs a bridge. And so we have a cash flowing asset that we're willing to stretch a little bit on that LTV. And so
I'll take the next one. Michael's got a question. So on the Colorado Springs loan, the borrower was paying interest on the full amount. So the all the reserves were sitting in cash in our accounts. And we had a interest reserve schedule, so we knew when the interest was going to be required to be used, and also the borrower had provided us with a proposed construction schedule with when they thought they would need to draw the funds down. So we had that set of information, and then on top of it, once a week, our whole team goes through and revises our weekly cash flow models. And so we track that very closely, and we make sure, what our future obligations on reserves look like relative to the cash on hand, deal pipeline, and new investor funds. So we manage that very closely. And actually, as of this morning, construction reserve exposure is less than 5% of the overall portfolio. So it's very modest. And obviously, a construction reserve doesn't go all out at once. So we're able to manage the cash flows very, very strictly and make sure that if and when they're needed, we have them available.
Okay, I've got a question here on from a person that's really asking about kind of our troubled loans. I might ask you, reach out to me directly, and I'll be happy to share our fourth quarter newsletter that we sent to all investors. It's got a loan tape with some summaries and some percentages, and I think you'll find that helpful. I think we're relatively low. We may have a couple million that, out of a much larger fund. We think we might be in the, 4 or 5% range of some loans with an issue of challenge. But once again, we're not in fear of any principal loss on those loans. They're just going through cash flow issues, and they may lead. We have several foreclosures in process, a couple receiverships in process. And as we work through those, we feel very good about our position on the underlying collateral. Just takes time and energy to get to some of that stuff. One of our good dear investors from Florida has some questions about the political environment in Portland. Some of the unrest is largely a downtown Portland driven thing. I think the media makes it look like the whole of Portland's on fire to some degree. But in general, we haven't seen this spill over and impact the areas of real estate where we would lend. and where we're active in. And so I don't see that being an issue. We do get to deal. There was a House bill that came out that put a moratorium on some lender practices that we've had to live through that fortunately expired 12/31. If any of you are reading the news about Portland, we're dealing with a massive ice storm. You know, I've been without power and internet since Friday, and still, you know, 30–40% of Portland area is without power, and that's crazy stuff. So anyway, we're super happy just to be here with you today.
Let's see, I'll take the next one. Michael's got a question on, do we loan on raw land? Generally speaking, we're hesitant if it's simply someone's buying ground or refinancing ground. We will loan against raw land if it's in connection with a construction loan. So we have a few loans in the portfolio that are the borrowers purchased land, but they are construction loans. So they've purchased the land and they've begun construction. So we will get involved with raw land that way, but generally speaking, no. If someone just has a bare piece of ground, we will not loan against that.
Yeah, and just one more thing on that, Sam. So on our loans on ground, they're to borrowers that have pre-sold them to national home builders with a contract and some money down. So there's the identified exit on those versus I think some of the more speculative development loans that people may do.
Yeah, exactly. And the point is, any raw land loan we're doing is the borrower will be improving the land in some way, whether it's entitlements or creating finished lots for a subdivision or building an apartment building. So the raw land is simply required as part of those deals, but just a bare piece of ground without a business plan, generally speaking, we would not do.
Yep. Let's see, can a client still invest in Sortis from a Fidelity wire? I believe so. The only thing, Fidelity, to be actually real specific, you can, we believe, invest through a Fidelity taxable account, just won't be reported on your Fidelity statement. You'll be direct investment with us, receiving your information with us. You cannot invest with us from a Fidelity IRA account. You'd have to be at a different custodian. And so we believe you can still technically invest through Fidelity, just won't be reported on your Fidelity statement for taxable investors. You reserve cash in your unfunded non-draw construction funds. 2 hours before this, every Monday morning on our end, we have a Sortis Income Fund meeting. We go over our liquidity, our deal pipeline, our draws, our expected fundraise activity. And when you're unlevered like we are, you have to manage your liquidity by frequent communication. And so we just work hard at trying to understand what's likely to come in terms of cash needs going in and out. And we generally have enough liquidity to fund all of our construction draws. I'll be honest with you, we have very little pure construction in the portfolio. We may have, I think I remember maybe one draw maybe this week that we may be funding. And so it was something pretty nominal.
Scott's asking, is the distressed fund still open? The answer is yes. So feel free to reach out to us directly or through our platform, and we'd be happy to talk to you about the distressed fund.
We have a webinar for that in early March as well. You'll want to tune in or reach out in advance. We've got a lot of opportunity that we're pushing into that fund. Every investor gets a tax restructure if they choose. Yes.
And then it looks like the last one in the block here from Eli is your relationship with our money. Are we buying someone else's note or participating? We're very sensitive to control over our loans and over our portfolios. So we will generally not buy participations in other people's loans because we don't have the control. So we do not generally do that. We have one loan in the portfolio that we sold a participation to, but we have the full control over the loan. So we're very sensitive over that because we feel we do the best job of managing our portfolio. So no, we do not buy participations in other people's loans.
Yep. Okay, moving over to the Q&A versus the chat. Loan default rates compared to the traditional lenders. please reach out to me, and I will email you our fourth quarter report that has our loan tape, and you'll get a little bit of a peek into a couple of the loans that are past due, and you can easily calculate that compared to total loans outstanding. Sortis and Fidelity on 4/1, yes, that is, I think that's the official date where people with IRAs are required to move to a new custodian. There really is little impact cash-wise on the fund related to that. Most of our RIA investors also work on the Schwab platform, and they've both checked with Schwab and moved the lion's share of their customers in that direction. Can you discuss the Mike Ferguson and Sam becoming the fund manager? I can. So Mike Ferguson is a longtime friend of mine, banker. He got offered a C-level position at a local community bank, pretty high profile position. And so we talked about that, and he decided that that was an opportunity, and I don't blame him in terms of while I love Sortis Income Fund, I love being on the private side of things. I understand that environment and the opportunity that comes with that level at that institution. But Mike and our team, we're friends. We talk about loans. He refers us deals, and so we left on very good terms. It just he had an opportunity he wanted to take advantage of. Is the equity Jeff?
As I say, in terms of stepping up in underwriting, so as part of my transition into the fund management role for SIF, I now spend 90% plus of my time on the loan business. So my role and responsibility on the equity side of our business has dramatically reduced. So I spend all my time on, nearly all my time on the Sortis Income Fund now. And in addition to Jeff, Paul, and I talking deals high level, we have a full-time staff of I think 9 people. And so we just hired a new loan servicer that works closely alongside me, in addition to the rest of our team that is all well-versed in loans and have accounting backgrounds and kind of understand the nuts and bolts. So we have probably 4 or 5 of us that spend most of our time working on the fund. So at this moment, we're covered for the volume of business that we're doing.
Yep. Let's see. Is the equity Jeff spoke of a fund or your growth fund? So a couple things. In our rescue fund, we acquire assets, equity in assets, and then we also do one-off deals, and we'll put together real estate acquisitions for investors. We may participate in them ourselves, not related to the Sortis Income Fund. And so I guess as it relates to equity acquisition, there's a couple different sources that we work on to facilitate acquisitions. Does SIF have a third-party due diligence report? To date, we haven't. We're contemplating that. We have an annual audit, and so our auditors come in, they look at our entire loan portfolio, they send out confirmations to our borrowers. I'm an ex-auditor, if you will, and we get a pretty rigorous underwriting of our fund and our activity annually, and we've done that. We've always had a clean opinion. We've never had any issues to speak of. And so, but we understand that there are some folks that like these third-party reports. And so when an audit isn't sufficient in terms of the work that's being done, we're contemplating whether to obtain that. And it's something we probably will end up doing simply because it makes our investors feel comfortable. In a sad sort of way, we kind of feel it's duplicative of a lot of the activity that's done by our external auditors, but nevertheless, it's kind of almost an expectation, and it helps people with compliance on their end when allocating. So it's something we'll probably do in the very near future. We just have to kind of plan that out. I will admit our time is right now being spent on wrapping up financial statements, getting tax returns done, and trying to get K1s out to investors in early March. And then we'll probably have to take a look at, maybe mid-year, early, maybe April, May, June timeframe, where we could take a look at organizing and coordinating something like that. Okay, well, we're a little past our time. Thanks for everybody that's with us. I think as it was mentioned that we will have a rescue fund webinar on March 2nd. And so that I think will be very insightful. We've got some really interesting stuff that we've been able to put together for that fund, and we have more opportunity related. So anyway, thank you for being here with us. We really appreciate all of you investors. Hopefully we answered some questions for those that either allocate to us or are thinking of investing with us. You know, I've had my contact information on the screen here for some time. Reach out to us. We're happy to answer any and all questions. We like to think we're incredibly transparent. So please don't hesitate to reach out. Thank you, everybody. I really appreciate your attendance today, and have a great day.